Welcome back, traders. Thanks for joining. In today's lesson, we will be focusing on Forex terminology. So, the 8 Forex terms every trader should know. So, before you even get into trading, we found out what is Forex, the foreign exchange, and now we're going to be doing the Forex terminology. So, when you're speaking to older traders, you would have an idea of what they're referring to. So let's dive straight into it. First thing, number one, currency pairs. So when selecting a currency to trade, you will notice that these come in pairs. So let's use the euro to the USD as a case study. So if you were to buy the euro against the USD, you would be betting that the euro is going to perform more strongly than the US dollar. Does that make sense? Let's go over it again. If you were to buy the euro against the USD, you are betting that the euro is going to perform more strongly against the US dollar. If it was a different pair, let's say the rand against the dollar, you are betting that the rand is going to perform more strongly than the dollar. If it was the dollar against the euro, you are betting that the dollar is going to perform more strongly than the euro. Okay, so when we speak about currency pairs, these currency pairs are normally categorized in 3 core groups. So we have our major pairs, our cross pairs, and our exotic pairs. Now, the major pairs, these 8 common pairs, all of which contain the USD, which is the United States dollar, as the base currency or counter currency as one of the following. So in the example above, we had the euro against the dollar. So here we have the euro again against the dollar. Then we have the CAD against the dollar, the Great British Pound against the dollar, and so forth, as you can see in the examples listed. Then we have the cross pair. Now these are any 2 major currencies which do not contain the US dollar as a base or a counter currency. So if we look at an example, we will see the Great British Pound against the Australian dollar. So it's not the US dollar as a base or a counter currency. We have the New Zealand dollar against the Canadian dollar. So any pair that does not have the US dollar as the base or the counter currency, that is what we call our cross pairs. Now, in the exotic pairs, these are quite literally exotic currencies. It's lesser known currencies which can be extremely volatile in the market. So these include your South African rand, your Hungarian forint, and your Polish zloty. Did I say that right? Zloty. Yes, the zloty. So those are your exotic pairs. Literally what it means is what the word means, that is what it means, exotic. Number 2 will be the leverage. Now, when you have your MetaTrader 4 platform, this we will discuss in the next video, all the applications that you will need to trade. But you will see on your main screen that there is a leverage. Now, leverage is in essence borrowed money from within a trading account. So trading with a leverage allows a trader to open a position with a high contract size with less expenditure. So when we're referring to contract size, we are referring to a lot size. When you're opening a high lot for your position, you are using the leverage from the borrowed money within the trading account. Now, high leverage trading is an effective way to trade for your favorite forex pairs like cryptocurrency as much more without investing vast amounts of capital. So if you find a broker that offers a high leverage, you can use this to your advantage. So let's just use for an example a popular pair, which is the Great British Pound to the US dollar. Now, based on a contract size of 100,000 per lot, a trader without using leverage would need $130,000. Now, if you take $130,000 and you divide it by 500, it will give you $260. Now, using the leverage of 1 to 500, a trader can open a position with just $260 in the account. Now the trader is controlling $130,000 with just $260. If this did not make sense, pause the video, read through it again until you understand it. Your leverage is important on your account. A 1 to 5 leverage is always a great leverage to have with a broker. Let's move on to number 3. Now, number 3 is your bid and ask price. So, when you're on your trading platform, you will see these two lines moving up and down, a red and a blue line, a red and a blue line, and you will ask yourself, what is this lines representing? Now, these lines represent the bid and the ask price. Now, the bid price is the price a trader is willing to sell a currency pair. Say that again. The bid price is the price a trader is willing to sell a currency pair. Now, the ask price is the price the trader will buy the currency pair. Now, these prices are displayed on the left-hand side of your MetaTrader 4 in the Market Watch section. What I've just explained, the two lines that will be moving up and down, that will be your bid and your ask price. Now, the difference between the bid and the ask price is known as the spread. So each broker also offers different spreads. If you find a broker with lower spread, you can use that to your advantage as well. Okay, let's move on to number 4. Now, going long or going short. You will always hear that traders are saying, oh, I'm going long on this pair or I'm going short on this pair, and you don't know what they're talking about. So when a trader is going long on a currency pair, for the first part of the pair is bought while the second is sold. Now, going long means buying a currency. Okay, you expect the price to rise, you expect the price to go up. You are going long, you want the value to increase. Now, for an example, if we use the Australian dollar to the US dollar, buying the Australian dollar against the US dollar, we are expecting the Australian dollar to rise. Now, when a trader is going short, the first currency is sold and the second currency is bought. So again, we use the Australian dollar to the US dollar. If you are going short, you're expecting it to drop. You're expecting the price to fall. So you're expecting the Australian dollar price to decrease. So going long means buying and going short means selling. Let's move on to number 5. Number 5 is margin. So margin is the initial capital that the trader needs to put up in order to open a position. Now, margin also gives the trader the opportunity to open a larger position. So when trading with margin, the trader only needs to put forward a percentage of the full value of the position in order to open the trade. Now, margin opens the door to leverage trading, but be wary because margin magnifies both profits as well as losses. So on certain brokers, if your margin percentage comes down to 50%, it will automatically close the trade that has the highest loss, which is open in the highest negative amount. So your margin percentage plays a major role in your trades, so you don't over leverage your account and you don't end up losing everything in your account. And that is why it's always good to practice risk management. Okay, let's move on to number 6. So number 6 is pips. So you will always hear traders saying, on this trade I caught 30 pips, I caught 280 pips, I caught 1,000 pips. Now you're wondering, what on earth is this person talking about? So the acronym for PIP stands for percentage in profit. So PIP is the smallest movement reflected in an exchange rate on a currency pair. Now, if you look at your chart, when we get to that section, you will understand what I'm referring to. But when you look at your chart, the PIP is the 4th decimal on the price quote for a currency pair. Now, it's used to measure the value. So for example, we're going to use Australian dollar to the US dollar again. The reason why I keep on using this pair is because this is the slowest moving pair. And this is the best pair to start with when you start trading. To focus just on one pair and trade that one pair, study that one pair for a couple of months, for a year, however long it takes you, you study this one specific pair, because no matter how fast it moves, it's still a slow moving pair, which means there's enough room for you to correct your errors. Back to the example. So the price is at 0.678. So that is the price that that is the price that the currency is currently at. Okay. So this means that 1 Australian dollar will enable you to buy about 0.6876 US dollars. Let me say that again. The price is 0.6876. This means that 1 Australian dollar will enable you to buy about 0.6876 US dollar, because we're doing the Australian dollar against the US dollar. So if the pip increased by 0.001 to 0.6877, remember the price was 0.6876. So if it increases by 1, it's 0.6877. This would mean that you can acquire slightly more US dollars for every 1 Australian dollar. That means that the price has moved up by 1 pip. If it had gone to 0.6879, that means that the price has moved up to 3 pips. Okay, let's move on to number 7. So number 7 is your lot size. Now, a lot in Forex trading is the size of the trader position that you will open. Now, a 1 lot is a standard lot in Forex trading on a currency pair that is equivalent to 100,000 units of a base currency pair. Okay, so 1 lot is what you would trade with if you have a very big account, because for every 1 pip that the market will move, you will gain $10 or you will lose $10. So if you use the standard lot size, which is a 0.01, that means that you are betting 1 cent, and it will increase 0.02, 2 cents, 0.03, 3 cents, and that is how the pip value work. So if we look at Euro USD, this means that opening a trade in the USD would mean that the trade is $100,000. Now, Euro being the base currency, 1 standard pip is worth $10. So this means 10 pip incremental movement in a buy trade, this would represent $100 gain. So this is based off a standard lot. Pips, lot size. Remember, your lot size is the most important thing when you are trading. Never go for a high lot size when you are starting to trade. Always use the standard lot size, which is a 0.01. Use that lot size for a complete year. You will see the growth. No matter if you're making small profits, you do not look at your profits as monetary value. You look at it as percentage growth. That is the way you want to grow your account. Okay, moving on to number 8. Bullish and bearish. So bullish will be your green candlesticks on your chart, and bearish will be your red candlesticks. Now, when the market is bullish, this means that the price is going up. Green means up. Now, when the market is bearish, this means that the price is going down. Now, the easy way to distinguish the difference and to remember is that bulls have horns. Okay? It has horns at the top of its head pointing upwards. That's the bull. Bullish. It means up. And the bears are when bears are provoked, they get on their hind legs and they tear things down. So price is going down. I hope this helped you guys. This is the end of my slideshow. I hope this information really helped you guys with the Forex terminology. So when you go back, you can, when you're speaking to traders, you would understand the terminology that they're using and you won't feel lost. Also, study this, make this part of the language, and you will succeed if you know what you are talking about. You won't feel lost when someone is telling you go long, go short, there's a bullish candlestick. But until the next video, guys, thank you for watching. I hope this was informative. Please like down below, subscribe, and turn on that notification bell so you can be notified when the next video will be uploaded. Cheers.